Welcome back everyone. We're going to be finishing out our coverage of CVP analysis in this video, but first I wanted to do a couple sort of review problems. So first up, suppose your firm makes and sells a single product. Selling price of that thing is $10. The variable expense per unit is $4. Your firm's total fixed expenses are $15,000 per month. Holding all other things constant, under what scenarios would your firm's break-even point decrease? So pause the video here, think through these potential answers, and then come back for the solution. So that would be F, only A and C. So if we increase the price with no other change to anything else, then yeah, we'll need to sell fewer items to reach break even. Our unit CM will also increase. C was fixed expenses decreased to $13,000 per month from $15,000. So if we have fewer fixed expenses to cover, then yeah, our break-even point will also decrease. I have to sell fewer things to get there. And then just to make sure we're clear on B, variable expenses per unit increased to $6. That would cause a decrease to our unit CM, right? Each unit I'm selling contributing less to the bottom line, so my break-even point would increase rather than decrease. Next up, let's assume you've decided to make and sell friendship bracelets for a laugh and to make some extra money. The fabric you want to use will cost $1 per bracelet. Beads and other bedazzling stuff will be 50 cents a bracelet. You're going to buy a hot glue gun used to attach the beads. It's going to be 30 bucks. Glue would cost about 5 cents a bracelet on average. You also intend to incorporate your business, and legal fees will be $300 for that. What's your contribution margin ratio if you make and sell 1,000 bracelets at $4 each in your first year? So pause the video, work through that, and then come back for the solution here. That would be C, 61.25%. So CM ratio, right, is CM divided by sales. We can do that in total, or we can do it on a per unit basis. I think it's probably simpler to do it on a per unit basis if we have that information, so that's what I've done here. The proposed selling price for these things was $4 per bracelet. The variable expenses are the dollar in fabric, the 50 cents in the beads and bedazzling, and then the 5 cents in glue. So $4 selling price minus those three items gives us a CM of $2.45 per bracelet. $2.45 divided by the $4 selling price means a CM ratio of 61.25%. Again, CM ratio tells us what portion of every sales dollar is potential profit. So for these friendship bracelets, that's 61.25 cents per dollar headed toward the bottom line. So first to cover all the fixed cost, and then to generate some kind of profit. Now back to our new material here and to set up our last couple of items in Chapter 5. The contribution format income statement, as we hinted at earlier, can also help us think about our relative cost structure. Since everything on here is grouped expense-wise by behavior, variable versus fixed, it really helps highlight what portion of our total expenses every period are variable versus fixed. So cost structure refers to that relative proportion, right? Firms are either fixed cost heavy, variable cost heavy, some kind of mix in the middle, or what have you. And managers do often have some latitude in determining that cost structure. Some examples might be investing in automation, right? Heavy fixed costs for automation, all the equipment and facilities that would go along with that, but we certainly, siphon off variable costs by doing that. There are certain advantages and disadvantages to all types of cost structures. So to high fixed costs or to low fixed cost. One advantage of high fixed cost structure is that if times are good, if the economy is strong, right, if demand is growing for our company as a whole, those good years, income will be a lot higher for companies with high fixed costs than for higher proportions of variable costs. The disadvantage is the exact opposite of the flip side of that. In bad years, or if the economy's bad or demand is bad for our products, if we have high fixed costs, our income is going to be lower relative to if we had higher variable costs. So it's the sensitivity to changes in demand and how that translates to changes in profitability, income, that really is determined by this relative cost structure. So all things equal, companies with lower fixed costs would enjoy greater stability from period to period, regardless of whether things are relatively kind of good or bad. So that sets up nicely here learning objective 8. We're going to compute the degree of operating leverage at a particular level of sales and explain how it can be used to predict changes in net income. We'll also talk about what it means in terms of risk. So operating leverage is a measure of that sensitivity we were hinting at a minute ago. How much does net income change with any change in sales? So it really is a measure at any given level of sales of what a 1% change in sales will do to bottom line profit. So we calculate it as the contribution margin in total from the income statement divided by that bottom line net operating income from the same income statement. So let's look at RBC, our favorite again here. They were selling in the current period 500 bikes, so sales of 250,000 all the way down to net income of 20,000. And we can see everything else in the middle here. So their degree of operating leverage would be their contribution margin at this level of sales, $100,000, divided by their net income at that same level, $20,000, for a DOL of exactly 5. Now, the degree of operating leverage doesn't have a unit of measure. This isn't 5 anythings, in other words, it's just 5. So looking at the number by itself doesn't tell us a lot from company to company, but it does tell us a lot for the company in question. And by that I mean, for RBC with a DOL of 5, that tells me for every 1% change in sales, they'll expect a 5% change in net income. Okay, so we can see how sensitive their bottom line profit is to changes in sales. If they had a 10% change in sales period after this, they'd have a 50% change in income. And that's what we highlighted on this next slide. We take the percent change in sales that's expected, 10%, times that degree of operating leverage, in their case 5, and there's our expected increase in profit. The other thing to keep in mind is this works in both directions. If I expected a decrease in sales of 10%, I'd expect a decrease in profit of 50%. So as this DOL gets bigger, the company's profitability is much more sensitive to changes in sales. All things equal, we'd say that that does make the company riskier. It doesn't mean it's good or bad per se. It's all about what the owners are willing to take in terms of risk, how much they're willing to accept these fluctuations in profitability. But the bigger the DOL, the more sensitive, the more risky profit is relative to those changes in sales. Oh, and real quick, here's the verification for this change for RBC. If they increase sales by 10%, they're increasing by 50 bikes, right? 500 bikes times 10%, 550. So sales jump from 250,000 to 75. And we can see that bottom line profitability moves from 20,000 to 30,000. So a 10% increase in sales, a 50% increase in income. And this again highlights what we were talking about earlier. If times are good, if demand's increasing, sales are increasing, the economy's strong, then yeah, I'd love to have a really big degree of operating leverage. Every little bit of sales I can drum up, I'm going to have a big impact on the bottom line. But if things are headed in the other direction, things aren't so good, it's going to hurt a lot worse and a lot quicker the higher my degree of operating leverage is. So it tells us that sensitivity to changes in sales, tells us the riskiness of that profitability. So let's look at an example here with our favorite coffee clutch, or our second favorite anyway, behind RBC maybe. So they're still selling coffee at $1.49 a cup with average variable expenses of 36 cents a cup. Their fixed expenses per month are $1,300, and they were selling on average 2,100 cups per month. What is their degree of operating leverage? Pause the video here, work through the problem, and then come back for that solution. So they would have a DOL of 2.21. So at sales of 2,100 cups, 2,100 times their $1.49 price is total sales of $3,129. Variable expenses in total are 36 cents a cup times the 2,100 cups, $7.56. So total CM $2,373. Fixed expenses of $1,300 leaves them with net income of $1,073. Contribution margin divided by net income, and there's our DOL of 2.21. Now, if sales were expected to increase by 20%, by how much should net income increase then? Same scenario as before. So pause this, work through that, and then come back through for the solution. So that would be 44.2%. So if I take my expected increase in sales of 20%, multiply it by my degree of operating leverage of 2.21, that means I'd expect a corresponding change in profit of 44.2%. Again, this goes in both directions. So if we expect an increase like this, hey, that's great. My bottom line profit jumps a lot. If I expect a decrease in sales though, man, that starts to hurt really quick. Okay, we just determined that Coffee Klatch's DOL was 2.21. Suppose the local Coyote Coffee or Starbucks or wherever you prefer currently has a DOL of 4.5. Which company would we say is riskier, and can we say one is better than the other? So pause this, think through the potential answers down here, and then come back for that solution. So the best fit there is A. We'd say that Coyote Coffee is riskier because their DOL is 4.5 relative to Coffee Klatch's 2.21. That means that their profitability is more sensitive to changes in sales. They're going to have bigger fluctuations in profit with an equal change in sales. We can't say, though, that one's better than the other or not. Depends on whether the risk is acceptable for owners. If we have very risk-seeking owners, yeah, they might love to have this DOL of 4.5. That way, if they can drum up some sales or the company can drum up some sales, they're going to feel it on the bottom line a lot faster. So we can never say one's better than the other or not, but we can certainly say one is riskier. And that brings us to our last learning objective for Chapter 5, to compute the break-even point for a multi-product company and explain the effects of shifts in the sales mix on contribution margin and break-even. So we talked about this in a previous video. Sales mix is just the relative proportion in which a company's products are sold. So maybe that's 60% product A and 40% product B, 70-30, 80-20, whatever. Different products certainly have different prices and also different cost structures. So because of that, they have different contribution margins. Some products are more potentially profitable than others. When a company sells more than one product, our break-even analysis that we've been using becomes a bit more complex. We can still do some break-even analyses and some target profit analyses. We just have to be a little bit thoughtful about how to incorporate two or more products. So let's do that with RBC. Let's assume instead of just selling bikes, that they sell bikes and carts, and that the sales mix between those two stays roughly the same every period. Let's say that bikes comprise 45% of RBC's total sales revenue, and the carts comprise the remaining 55%. RBC gives us some income statement information that we've shown here. There's our bike segment income statement, and that's just what we'd kind of seen before, selling 500 bikes, so $250,000 worth. Let's also assume they're selling $300,000 worth of carts, which generates a contribution margin of $165,000. And again, that constituted 55% of total sales. So at the company-wide level, we've got sales of $550,000, a contribution margin of $265,000, because we had variable expenses in total of $285,000. And that's just summing across the two products. Company-wide fixed expenses are $170,000, and then company-wide net income $95,000. Now, what we want to do for our break-even and target profit analysis, if we take it that far, is to come up with what amounts to a weighted average CM ratio across all the products. So what we do is we just look at that condensed company-wide view of sales and contribution margin. We take total CM company-wide, $265,000 in this case, divided by sales company-wide of $550,000, and that gives us a company-wide contribution margin ratio of 48.2%. So we can see that's in the middle of the bikes at 40% and carts at 55%. Right? Essentially, it's the weighted average of those two numbers. And what that tells us too is RBC on average, for every dollar in sales they generate company-wide, they generate about 48.2 cents in contribution margin for that dollar of sales. Now, if we want to find the dollar sales to break even, then we can use the same tool we did before. Take our total fixed expenses, this would be company-wide, divided by that company-wide CM ratio. So for RBC, that's 170,000 in total fixed expenses. Just show where that is here on the company-wide income statement. Divided by that company-wide CM ratio of 48.2%. And there's my break-even sales of 352,697. And then what I've done below here is just kind of prove that out with the rounding errors anyway. So company-wide sales of 352,697. If I multiply that by my 48.2% CM ratio, I'd get company-wide CM of 170,176 minus my fixed expenses of 170,000, and there's my break even, at least with some rounding error. The other thing to point out is that at this total company-wide sales of almost $353,000, we're assuming that 55% of it is carts. So 55% of that number is 193,983, and we're assuming the other 45% is bikes. So 45% of the 352 and change means bike sales of 158,714. So think about this, a shift in the sales mix then from products with high CM ratios toward products with low CM ratios will raise the break-even point for the company as a whole. Is that true or false? So ponder that for a second, pause this video if you need to, and then I'll have the solution right away. So that is true. We're saying if we're selling a relatively higher proportion of products with lower CM ratios, that means everything we're selling is generating fewer pennies on the sales dollar that are going toward the bottom line profit. So that's going to cause an increase in that break-even point. If the shift was in reverse, if we're shifting from products with low to high CM ratios, then we'd be decreasing the break-even point, right? More pennies on the dollar headed toward the bottom line means I have to sell less to get there. Okay, but here, if we're shifting from high CM ratios to low, then fewer pennies on the dollar headed toward profit. It's going to take us more in sales to get there. Okay, well that wraps up the sort of notes and discussion here for Chapter 5. As always, please do let me know if you have questions.